Today I am going to be talking about standard and itemized deductions and comparing and contrasting them. So what are these things? The standard and itemized deductions are both deductions that you can take to reduce your taxable income or the amount of taxes that you owe. However, the IRS allows you to only take one of these two deductions and you cannot take both of them, but which one you want is up to you. Now, common sense would tell you to pick whatever deduction is the greatest, because you want to be picking the one that maximizes your deductions, since that will reduce your taxable income by the most. So this isn't exactly pick and choose whichever one you like. If you want to save money on taxes, you choose whichever deduction. The standard or the itemized deduction is greater. The trend is that usually taxpayers with lower income take the standard deduction, while high taxpayers take the itemized deduction. So these are the similarities, right? They're both deductions which serve to reduce your taxable income. But what are the differences? Well, they're pretty drastic. So let's go over the standard deduction first. So the standard deduction is a fixed, unvarying amount of deduction that you can take across different taxpayers to reduce your taxes. This amount does not change except for changes in filing status, which we will discuss in a future video, but they are constant across different taxpayers with the same filing status, and it will also change from year to year because it needs to be adjusted for inflation. But holding those two variables constant, the standard deduction amount does not change across the nature of the taxpayer. And what do I mean by the nature of the taxpayer? Well, it doesn't matter if the taxpayer makes $50,000 or $500,000. It doesn't matter if the taxpayer owns a business or does not own a business. It doesn't matter if the taxpayer has medical expenses and the other doesn't. It doesn't matter if a taxpayer has A, B, and C and another taxpayer has X, Y, and Z. No matter what, the standard deduction for both taxpayers is the same. Again, it is a fixed, unvarying amount of money that you can use to reduce your taxable income. As of 2022, for those who are single and file single, this amount is $12,950. Now, there is something called standard deduction for dependents. That is not this amount, but here I'm referring to the general normal standard deduction, which does not vary again. In addition, the standard deduction can also be increased if you are over the age of 65, or if you are blind, or if you are both. But again, I'm just referring to the general normal standard deduction amount, and that does not vary. And even for those who are blind, for those who are over the age of 65 or both, the amount that they can increase their standard deduction by is also the same across different taxpayers. Now, what about the itemized deduction? Well, you may have guessed it by now, the itemized deduction does vary across the nature of the taxpayer. In fact, it's specifically designed to vary to allow taxpayers who have specific expenses to be able to take these as deductions. So the itemized deduction is made up of the sum of many different deductions that the IRS has set aside to be included to the total itemized deduction amount. Now, briefly, just for this video, here's the list of examples of itemized deductions. And these deductions right here make up your itemized deductions. Now this list is not exhaustive, so there will be other things that make up your total itemized deduction amount, but these are the most common ones. So let's say you have medical expenses and interest on home mortgage, but you don't have any other itemized deduction. Your itemized deduction amount would be the sum of your medical expense deduction and your deduction for interest on home mortgage. So it is the sum of these specific deductions and some other deductions that are not included in this list. Now, itemized deductions are also known as deductions from AGI, and I go over examples of deductions that make up itemized deductions in part 8 of the series. And that reminds me of another similarity with standard and itemized deductions. Both of these deductions do not decrease your adjusted gross income. There are some deductions, namely deductions for AGI, which not only reduce your taxable income, but your adjusted gross income as well. Standard and itemized deductions do not, however. But you can see here why, unlike standard deductions, the amount for itemized deductions will change from taxpayer to taxpayer because different taxpayers will have different amounts of medical expenses, different amounts of interest on home mortgage, and etc. etc. You can see Schedule A for filling out your itemized deductions. So I hope this video has helped clarify and explain what the standard and itemized deductions are and its similarities and differences.